CPI numbers just came out this morning, the lowest they've been in 2 years, like 2 years as they were on their way up. So why do analysts think the Fed is going to raise the Fed rate again? So let's talk about what really happened in the CPI report this morning. I want to highlight some things and talk about the next report that's coming out and what it might also tell us. So we got the headline and the core CPI this morning, and if you were watching the stock market, it was celebrating a drop in the headline from 4.9 all the way down to 4.0. We saw a 0.1% month over month, which dropped the headline number dramatically, substantially. The stock market loved it. The bond market, for a minute. And here's why. Because the core did what the core has been doing. So core inflation strips out food and energy. And that number didn't drop so good. It went from 5.5 to 5.3, which is certainly in the right direction, but it still sat at a 0.4% month over month. Now, we dropped off a higher number from last year. In fact, we were just under 0.7% month over month a year ago. So that number dropped off. And then if we add the numbers up, now we have 5.3 because we dropped that about 0.2%. That's good news because it's in the right direction, but it's still sticky. We've had a 0.4% month over month for the last 6 months. So that's just telling us that core inflation is not coming down, and that's what the Fed is watching. They're really watching PCE, which isn't going to come out for another couple of weeks. The difference between PCE and CPI is really what you're feeling, like in your wallet. It's a consumer's inflationary number. The PCE is more of an economic, a broader, business-wide number, but it also takes into account when consumers trade items, like if I go to the grocery store and I'm not buying the name brand anymore, I'm buying the generic brand, that actually gets weighed into the PCE. So it's looking at a measure of discretionary choices that go into inflation. CPI doesn't look at that so much. But here's a couple of numbers that held the CPI core up. One of the biggest numbers, used cars up 4.4%. So car sales up 4.4%. That's a high number when you're talking about price jumps. And that was the same actually as last month. We also saw housing. It didn't drop at all. It stayed the same as last month at 0.5% month over month. So these numbers are continuing to stay sticky. So what's the Fed gonna do? You know what the Fed rate is right now? It's 5.1%. What's core inflation? I just said it. It's 5.3%. So as long as the Fed rate is less than inflation, it's actually stimulating. So with the stimulus situation, you want the Fed, or the Fed wants, I don't want it, the Fed is more than likely going to raise the Fed rate. But not tomorrow, not this month. So we've got the Fed meeting coming out, or Powell will come out and give his speech and then answer questions Wednesday tomorrow at noon. So if you ever geeked out on this kind of stuff, he has his own YouTube channel. So that's kind of a thing the Fed does, and you can find it and you can watch it and you can be sure that I will be watching it. So that's tomorrow at noon. And he'll be talking about what they're thinking. And there's a very high probability that they will skip this month. We've already started talking about it and the market has already baked it in. If he changed course today, showing it his hands tomorrow, it would absolutely impact the markets. I don't think he's going to do it. But he's going to skip, which is a big difference from pause. The choice of words is critical, which is why I always watch the Fed meeting or the minutes when they're released, because their word choice speaks volumes. They're not pausing. They haven't raised rates and then they're going to pause with a transition to dropping rates. No, they've been raising rates. They're going to skip a month and then could possibly continue to raise rates. And that's what the analysts are thinking right now. They're thinking that the Fed has got to raise the rates at least another quarter, if not 50 bips. They could do 50 bips all at one shot, or they could do a quarter 2 months in a row. Now, you have other analysts that say that they're just going to stay where they are and let inflation drop below the 5.1. But will that take several months? And are they willing to wait? We know the Fed, and so far they haven't been willing to do that. And if we see the Fed jumping rates again, it's going to create more instability and uncertainty and create more volatility in our 30-year mortgage rates. Right now, the bonds did not like the news that the core was staying sticky. So it started to celebrate for a hot minute when it saw the headline number. And then when the core number kind of settled in, it's actually started on its way back up again. And of course, with the Fed meeting tomorrow, typically in the morning, we're going to see a hold on a lot of mortgage rates with a release where they're going to drop if they say anything that gives us excitement, like that they are not going to raise the rates at the following meeting, where they're going to continue to hold and for a longer period of time. Go high, stay longer. The other news that's happening besides the Fed meeting tomorrow is the PPI numbers. So stay tuned for that. We'll definitely be talking about that with Megan on Thursday. But the PPI numbers, remember, is the producer price index. So the CPI is the consumer price index. That's what we're feeling when we go to the grocery store and the gas station. But the PPI is what the producers feel. It's more of that, it's further up the supply chain, so it's more of a wholesale number. When the PPI starts dropping, and it's dropped substantially, when that continues to fall, eventually it ripples over to our CPI and our PCE numbers. And remember, the PCE is what the Fed is watching. So tomorrow's PPI could be massive in showing us the direction of the continued strength of dropping the inflationary numbers. All of that is good news for our mortgage rates. Because remember, the mortgage rates are not tied to the Fed rate. The Fed rate is tied to inflation. Inflation affects the 10-year Treasury yield, and that 10-year Treasury yield is a sister to the 30-year and the mortgage rates. Well, I'm going to keep this one short. The news is what the news is, and Thursday's market update is going to have that and more. Tools that you can use as a real estate agent if you're watching this, how we're looking at the numbers as far as buying versus renting, the cost of waiting, and all the things. So I hope you guys have a fantastic rest of your week, and I'll talk to you very soon.